Over the last 50 years, average house prices in the UK have surged. In particular, the growth in house prices has outpaced the growth in household income, with the average house price reaching a record 7 times average income in the third quarter of 2022. The substantial growth in house prices can be attributed to multiple factors, including higher household income, an increase in joint income applicants and mortgage availability, although particularly since the global financial crisis, negative real interest rates have been a key driver. Following the pandemic, several factors both on the demand and supply side have kept house prices buoyant, although this year the growth in house prices has eased in part due to the economic turmoil created by the cost of living crisis. Surging inflation is eating through savings, eroding real earnings at record rates, and causing interest rates to rise, which is adding upward pressure on mortgage costs. Survey evidence also suggests that business confidence in the construction sector has fallen to its lowest levels for over 2 years. Over the past 3 years, average house prices have grown by around 6% a year. This pace was well ahead of general price inflation and of household income growth. Such a pace of house price growth starts to put pressure on affordability for mortgage borrowers in terms of both the size of their prospective mortgage interest payments and on the size of deposit needed to buy a property, especially for first-time buyers. While the effects from Russia's war on Ukraine have changed global economic dynamics in terms of inflation and policy interest rates this year, it is hard to believe that annual house price growth running well ahead of general inflation and income growth would have been sustainable for many more years. The economic shock and the subsequent increase in interest rates is very likely to reduce the pace of activity in the housing market, and house prices could fall as a result. The continued rise in energy and food bills is reducing demand in the housing market. In the first 8 months of 2022, housing transactions, a measure of housing demand, which is the number of sales, exchange, or rental of properties, were 12% lower than the same period in 2021. As a result, house prices have decreased. For the 3 months preceding September 2022, house prices in the UK remained flat. In response to soaring inflation, the Bank of England continues to increase the bank rate, which is now 3%. Many interest rates on loans provided by banks, including residential mortgages, follow the bank rate. Subsequently, an increase in bank rate will be translated into higher mortgage rates, although not necessarily by the same magnitude. The increase in mortgage costs will directly impact variable or tracker rate mortgage holders rather than fixed rate mortgage holders. However, buyers applying for a fixed rate mortgage or existing fixed rate mortgage owners who will be refinancing will also be impacted by higher rates. Consequently, irrespective of the stamp duty cut announced in the September mini-budget and confirmed more recently in the autumn statement, prospective buyers will be less likely to apply for a mortgage because of higher monthly mortgage payments, at a time when inflation is eroding disposable income, dampening confidence, and there is greater job insecurity. In turn, this will reduce activity in the housing market and the growth in house prices. On the other hand, existing homeowners who may wish to sell their property and move may be discouraged from selling their home, as they may not want to purchase a property at a higher price when prices are expected to fall as the housing market loses steam. As a consequence, this may limit even further the number of properties available on the market. If we look back at 2020, the total amount of first-time buyers joining the property ladder fell, most likely due to the economic impact of the pandemic. However, in 2021, the number of first-time buyers surged by 34%. This increase occurred across all regions of the UK and can be explained by the stamp duty holiday provided by then Chancellor of the Exchequer, Rishi Sunak, as well as the underlying change in demand towards larger properties to accommodate remote working. So, considering this, will higher mortgage rates put off first-time buyers? Probably not. Firstly, we have another stamp duty incentive which may provide underlying support for the first-time buyers group. However, more importantly, 62% of first-time buyers were from wealthier backgrounds in 2020 to 2021. Moreover, 72% of first-time buyers paid a deposit of less than 20% of their property value, while 5% bought their properties outright. On the other hand, some first-time buyers may be discouraged irrespective of the stamp duty incentive because of the cost of living crisis and the risk of banks reducing loan-to-value ratios in periods of economic uncertainty. Overall, although we expect house prices to fall over the next couple of years, it is unlikely we will see anywhere near as significant a decline in house prices as we saw in the global financial crisis. During the global financial crisis, between October 2007 and February 2009, house prices fell by 21%. We expect UK house prices to fall by a little over 10% over the next couple of years, but this is only half of the fall experienced in the global financial crisis, and it would still leave house prices roughly where they were in 2021.